For the last two videos, we've talked about investment real estate as an investment asset class. Of course, the challenge already identified is that when you sell investment real estate, you now have to recapture depreciation and you'll be also taxed on capital gains. Are there strategies to defer gains or maybe even eliminate them on the sale of your property? Hello, my name is Paul Carroll. I'm the CEO and founder of Avion Wealth, an elite wealth management firm here in South Texas. The short answer is yes, there are three primary strategies available. One is the 1031 exchange. The second is a qualified opportunity zone. And the third is the installment sale. Now, in the last video, we talked about the simplest one, that's your personal residence. If you own a personal residence for more than a certain amount of time and lived in it 2 out of 5 years, the sale of that property, if you're an individual, can roll over $250,000 of capital gain. If you're married, $500,000 of capital gain into your next property. As an investor, I'm going to talk about installment sales first. Installment sales is basically, it's not an indefinite deferral of capital gains. It's a strategy where as you receive payments for your property, pro rata portion of that payment is a capital gain, and so you're staggering the realization of the gain over the period of the installment sale. For those investments who carry their own note, who actually are also investing in the mortgage for essentially, and that can be a great sidebar alternative strategy, installment sales can be very useful. Two other are the qualified opportunity zone and the 1031 exchange. A 1031 exchange allows the sale and reinvestment of gains without paying capital gains tax on that sale. Those gains are rolled into the next property. And how does it work? We sell the property. You're supposed to ID a replacement property within 45 days. So you've got a warehouse, you sell it, you got $1 million in gains you don't want to pay tax on. You find another property, and there are constraints and rules as to the identification of that property within 45 days. You now have 180 days from the time of sale to purchase that property, to close and make the payment. And in essence, the IRS treats it as the same property, but just different. And what I mean by that is all the gains and all the depreciation rolls into the new property. You've deferred those gains. It's a great strategy. You may have a reason to get a bigger property, or there might be a reason you need to sell the old property. Maybe the neighborhood's going down. The pros of this strategy, of course, are tax deferral, continued real estate diversification through holdings, and flexibility. You save taxes, you get to keep the cash, you can invest more money for future growth. However, there are cons, and the first and foremost, this is complex with very strict rules. You've got a limited time frame to act, you've got limited options. And deferring taxes usually is a good thing, but not always. If you're in a lower tax bracket now than you think you will be down the road, maybe you should just pay the taxes. Unless you're going to use the ultimate tax strategy, and that is deferring gains until you die. And assuming you're below the estate tax exemption, well, you get a step up in basis and you never pay the tax. Invest, borrow, and die is a fairly well-known strategy used by the ultra-rich to avoid paying taxes. The only catch being, of course, you do have to actually die. Fortunately, none of us get out alive in the end. There are firms that help with this 1031 exchange process, and we've partnered with one or two. They do a wonderful job at making it easy. They still don't take over the responsibility for the identification, financing, and closing of the new property, but they make it work and they keep you within the confines of the law. But I always warn people, don't let the tax tail wag the dog. Sometimes the net benefit of tax deferral isn't that great. The tax bill may not even be that. It may be a $15,000 bill. Okay, that's nice. We've rolled over 15 into a new property. We may not want to do that. Maybe we didn't want the constraint. Maybe there are other reasons, including and not limited to, this is a low tax bracket year, and we're just not going to pay much tax on it. Why defer it to another year when you may pay 15, 20, 50, 100% more tax on the same gain? So be careful not to let the tax tail wag the dog. In the next video, we're going to talk about workarounds to further improve on the 1031 exchange. Sometimes you can't find a great alternative property, but there's a way to deal with that. This is complex stuff. There's a lot more. We could talk about it forever ad nauseum. I could put you to sleep with it easily. But if you need more information or like to talk about this in greater detail, please feel free to call or email me. We wish you the best of real estate investing success. Thank you.